So the question is, in case of malls, a target company whose valuation you are trying to attempt has taken the mall's premises on rent and it is paying lease rentals, whereas the reference company or comparable company owns the buildings and it is incurring the depreciation cost. So the point is, in a case like this, should you take EBITDA multiple or should you take EBIT multiple? And the answer is, in a case like this, you should take the EBIT multiple and not the EBITDA multiple. And why is that so? It is because when you calculate EBITDA, now what will happen? EBITDA, how do you arrive at the figure of EBITDA? Gross profit minus SG&A. And therefore, the lease rentals that you would pay for your company, your target company, whose valuation you are trying to do, you will deduct as part of the SG&A the lease rentals, whereas your reference company will have the figure of gross profit and will have the figure of SG&A cost, and this is how they would arrive at the figure of EBITDA. Now, what will happen is, the EBITDA figure, from the figure of EBITDA, what you will deduct is the depreciation. Now, that means what is happening is, in case of the company which is owning the malls, there is no cost coming in the EBITDA profit on account of those malls, right? Whereas the company that owns, in case of that company, depreciation will come, but depreciation will come after the EBITDA. So what is going to happen is, and just pay attention, what is going to happen is, in case of the company which owns the premises, they will be incurring the lease rent, and lease rent will be deducted, and that is how you will arrive at the figure of EBITDA. यानी कि जो आपकी EBITDA है वो डिप्रेस होके आएगी by the amount of lease rent. लेकिन जो कंपनी premises को ओन करती है उसमें तो ऐसा कोई कॉस्ट नहीं आएगा लीज रेंट का, बिकॉज वो तो ओन करती हैं, तो उनको तो डेप्रिसिएशन कॉस्ट है, और डेप्रिसिएशन कॉस्ट आप कहाँ से माइनस करोगे? एबिटा में से माइनस करोगे. सो योर एबिटा फिगर इन अ केस लाइक दिस इज नॉट गोइंग टू बी कंपेरेबल. सो देयरफॉर यू शुड यूज not the EBITDA in a case like this, you should use EBIT. And why is that so? That is because, having computed EBITDA of both the companies, now what you will do? You will deduct the depreciation from the figure of EBITDA for the company that owns the buildings of the mall, right? And whereas in case of the company that has rented the premises, you do not have to make any adjustment on account of depreciation, because this company does not own the assets. And at the same time, the figure of EBITDA of this company has already arrived after taking into account the lease rent that the company has paid. So now when you deduct the depreciation from the EBITDA of the company that owns the assets and you arrive at the figure of EBIT, now this EBIT figure is comparable, is consistent. So both the companies, because in case of both the companies, you have adjusted the cost of using those buildings. In one case, you have adjusted the cost by way of lease rent. In other case, you have adjusted the cost by way of depreciation. And that is the reason why it is suggested that when you are making a comparison of trying to do the valuation by making a comparison of companies with two different kind of business models, you should not take into account EBITDA multiple for the purpose of valuation. You should take into account the EBIT multiple for the purpose of valuation. Sir, I hope this makes sense to you.